Okay, so I said in the end of the last video that when we sell on account or complete services on account, there's some risk. So what is the risk that comes up from this? Well, if there's a chance that customers won't pay us, that is the risk. So that a customer won't or never pays. So maybe they go bankrupt, they just run out of cash and their business closes and you're never able to collect that. Or it could be a small, just individual customer who leaves town. You're not able to track them down, so you can't collect that amount. So if we know this risk exists, why do businesses take that risk? Well, there's a few reasons. First one is that most customers do pay. So it's not a huge risk that every single customer is just never going to pay you. Most do, and it's the exception that a small amount of customers don't pay. And then the other reason is that most companies do offer this. So we could say most other companies do offer. So if you're the one company who doesn't allow customers to buy on account or to get services on account, they might end up choosing one of your competitors. So they choose someone else so that they can actually get that credit and they don't need to pay right away. So if one particular business doesn't offer it on account, they might be losing out on sales and therefore losing out on money. So it's not just willy-nilly that any business lets anyone purchase on account. There's ways that you can reduce this risk, and it's what we can call credit approval is required. So before a business will let a customer actually buy things on account, they need this credit approval. So there are various things that could go into that. Maybe they request the company's financial statements so they can review that, look at their current ratios, see if they're likely to be able to pay. They'd probably do some Google searches to see if the company's nearing bankruptcy. They may get a letter of credit or a reference from the bank to say, yes, like we think they'll be able to pay, things like that. So there are these steps that a business will take before they grant credit to a customer. But even with these things going on, there is that risk that customers will not be able to pay and that a business won't collect. So when we're looking at accounting for uncollectible accounts, we call these bad debts. So we've talked about these benefits and the cost or the risk. And in the end, some accounts receivable become uncollectible. And this is an expense to the company because we know when the benefit goes away from an asset, and AR is an asset, so when that future benefit is gone, it becomes an expense. So if something becomes uncollectible to a business, there's no future benefit because we're no longer going to collect that cash. So the benefit's gone, it becomes an expense. And we call this bad debt expense. So if somebody is not able to pay us, it's a bad debt and it is an expense. And this is an operating expense on the income statement, so it would go under selling expenses. Because part of us selling goods means or providing services is this risk that we won't collect. So that's where that would be shown on the income statement. And bad debt expense needs to be recognized in the same period that the related sales revenue, this should be sales or service revenue, is reported. So remember we talked about the matching principle where we need to match the expenses in the same period that the related revenue was recorded. But think about this. how do we do this? Because if we sell to someone in a month and we allow them to buy on credit, we expect that they're going to be able to pay. If we didn't, we wouldn't allow them to have that credit. We would have made them pay in cash. So in order to recognize the expense in the same period, we actually have to do what's called an estimate. And this is done through the allowance method. So through the allowance method, we estimate the uncollectible amount at the end of each period. So we do this based on past experience of the business. So long-running businesses, they know how often an uncollectible amount will occur or certain percentages where this happens. So at the end of each period, we're going to look at a few methods of how we can estimate this uncollectible amount. And because we're doing it at the end of each period, we're actually having bad debt expense matched in the same period as the sales revenue, which we talked about that matching objective. So using the allowance method is also following the principle of conservatism. So we introduced this when we talked about inventory and looking at the lower of cost or net realizable value. And using these estimates is another example of conservatism. As a reminder, conservatism says that if there's any doubt, we need to account for it based on the least desirable or worst case scenario. So if there's that doubt or risk, we look at what's the worst idea and estimate based on that. So that's what we're doing under the allowance method. When we actually go ahead and do this, so this is kind of the how we're going to estimate these, we set up a new account. So the estimated uncollectible amount goes into this new account that is called the allowance for doubtful accounts. And you know by now that accountants love acronyms, so this could be referred to as AFDA, allowance for doubtful accounts. So again, it's an estimate, and therefore it's doubtful, but we don't know for sure. And this new account is another new contra asset. So it's going to be linked to the accounts receivable account, and it will have this credit balance that goes there. So it sits with AR and reduces the overall net amount that we think we'll collect. So this is an overall estimate related to AR, and it's not related to a specific customer. So that's important. And that's why we need this contra account, because we can't remove something from AR without knowing the customer that it links to. And that's because, as I've shown you, we have these subledgers, and these are part of AR. So you're linking each transaction from your GL, links to a customer, and then sits in this subledger. So to remove the amount from accounts receivable, we need to know the specific customer. But at this point, when we're doing the allowance method at the end of each period, we don't know the specific customer, it's just an estimate. So we use this contra account for that reason. And this contra account is shown below and netted with AR to determine the carrying amount. So the amount that we carry it at on the balance sheet, and that's why it's called the carrying amount. So this is what that looks like. If you were to see a balance sheet where there was this allowance, you would see it like this. You have the full AR amount, then you say less the allowance for doubtful accounts, and it gets you to the net accounts receivable, and this is the carrying value. The net amount that we're saying we will carry this at on the balance sheet. So the $10,000 accounts receivable, this is the full amount owed by customers. So of all the invoices and sales that we made on account, this is the full amount. The allowance for doubtful accounts, this is the estimate of uncollectible amounts. So what we don't think we'll get. And the net amount is what we think you'll actually collect as cash. So you want to know, or another reason we do this contra account, the AFTA, is because we want to know what's still fully owed to us. We're still going to try to get that full $10,000. We just know we need to be conservative because there's the chance we won't collect $900 based on our past experience. So to be conservative, we show this net amount, but we want to know the full $10,000 so we can still try and get that from customers. Okay, so what this $10,000 AR, what would the normal balance for that be? A debit or a credit? Right, this is a debit. We know that's the normal balance. The contra asset, the AFTA account, the normal balance here is a credit. So if we really quickly do a T account, this is where the information would have come from, these ledger accounts. So we have the $10,000 debit in AR, and we have a $900 credit in AFTA. So the net of these two accounts is the $9,100 carrying amount. Okay, so now we know what it looks like. And in our next few videos, we'll go through the different methods that are used to actually come up with this estimate for the allowance for doubtful accounts.